Once you learn about ETFs, I bet you will never invest in mutual funds again because you will save yourself a ton of money and you will avoid unwanted surprises along the way. What's going on, everybody? My name is Chris and I have been active in the stock market for 9 years now, and today we are going to explore the world of ETFs so you can save a ton of money and avoid unwanted surprises along the way. And I will also share with you the magic that makes ETFs efficient. And at the end of the video, I will be actively buying and shorting shares of an ETF so you can clearly see how to buy and sell shares of an ETF using real trading software. So be sure to stick around for that. Our journey has to start somewhere, and that's with the basics of an ETF. So what is an ETF? Well, first, ETF stands for Exchange Traded Fund, and that basically tells us what it is. So an ETF is like a mutual fund, with the exception of the shares being traded publicly on a stock exchange, just like shares of Apple or Microsoft. So to buy or sell shares of an ETF, we do so publicly on the stock market, just like we would if we were to buy or sell shares of Apple or Microsoft. An ETF is similar to a mutual fund in that it buys up a pool of assets and then issues a large quantity of shares to investors so that small investors can buy some shares and therefore own a portion of the fund's overall assets. To give you a very basic example, let's say there is a painting worth $100 million and I want a piece of the action, but unfortunately I'm broke and I don't have $100 million in the bank account, so I cannot invest in this painting. Now, one way we can work around this is, let's say the creator of that painting creates a fund holding that $100 million painting in the fund. And then the creator of that fund issues 20 million shares to make up the whole $100 million value of that fund. Now, since the fund's assets are worth $100 million and they issue 20 million shares, then each share would be worth $5. So $100 million divided by 20 million shares gives us a share value of $5 a piece. And now, with just a few dollars, I can buy a share of this fund, and therefore I will own a portion of that $100 million painting, and therefore I can participate in the increase or decrease in the value of that painting over the course of the future. The last step in creating this fund and making it into an ETF is to publicly list the shares on a stock exchange. And so once we do that, then investors from around the world can buy shares of this fund and therefore buy partial ownership of this $100 million painting. Now it doesn't matter that I'm broke and don't have $100 million to buy this painting, because if I buy 100 shares of this fund, I will pay a total of $500 for those 100 shares, and therefore I will own a portion of that painting. Now let's say a few years down the line, the painting ages very well and increases to a value of $200 million. Well, now, since we have a total asset valued at $200 million and there are 20 million shares representing that total value, well, now each share is worth $10. And since I own 100 shares, my $10 share times 100 shares equals $1,000, which means I have doubled my investment from the initial purchase price of $5 per share. So an ETF is a way to divide a portfolio of assets into a lot of tiny parts called shares, and by doing so, we allow investors of all different sizes to participate in ownership of that fund's assets. So it's actually very similar to buying shares of Apple, because when you buy shares of Apple, you are buying a portion or part ownership of Apple, the company. When you buy shares of an ETF, you are buying part ownership of the fund's assets, and depending on what that ETF's objective is, that is going to determine what assets that fund holds. So the basic painting example illustrates basically how ETFs work, but now let's transition it into the real world and look at one of the most popular ETFs out there, which is SPY, and that is the S&P 500 ETF. So let's go and explore SPY and learn exactly how it works. SPY, or SPY as they say, attempts to track the performance of the S&P 500 index. Now, it does this by purchasing all of the component stocks that make up the S&P 500 index, and they buy all those stocks in the appropriate weightings, and then the fund issues shares to investors so that when people buy shares of SPY, they are essentially buying part ownership of all of the fund's assets, which is exactly the components that are in the S&P 500. So when you buy one share of SPY, you are technically buying 505 different stocks. One of the important things to do when you're exploring ETFs to invest in is to go to their website and look at the information that they provide, because you can learn a lot about an ETF simply by going to the official website for that fund. So if we go to the website for SPY, we can see that first and foremost, it gives us an objective. Now the fund objective is what that ETF is attempting to accomplish through its investment activities. In the case of SPY, the objective is to track the performance of the S&P 500 index before fees. Now, more importantly, we can actually see the ETF's annual fees on this page as well. And in the case of SPY, the fee is 0.09% or 9 basis points per year. This means that if you invest $10,000, you will pay $9 in management fees for holding that investment over the course of a year. And we'll talk more about fees later, but just know that a fee of 9 basis points is incredible, because that basically means you're paying close to nothing in management fees every single year on the amount that you have invested. The next thing you can look at is how the ETF is performing relative to the index that it is tracking. So on this page, we can gauge whether or not SPY is achieving its objective by looking at the fund's performance, or SPY's performance, relative to the performance of the S&P 500 index itself. And when we look at these numbers, we learn very quickly that SPY is crushing its objective, because the SPY returns are very, very close to the S&P 500 index returns over all the periods that are listed here. Also on this page, we can see that the SPY ETF has a total of 505 holdings and has assets totaling around 389 billion. And with a total number of shares of around 873 million shares, we can calculate that per share value of around $445 per share. Now it says NAV here, which means net asset value. A fund's net asset value is essentially the fund's assets minus liabilities divided by the total number of shares outstanding. So in this case, basically we're just taking the fund's assets, dividing by the number of shares outstanding, and we get a per share price of $445. Now this is really powerful to understand, because if you wanted to go out and buy a cross section of the US economy and basically create your own S&P 500 portfolio, you would need tens of thousands of dollars to go out and buy shares of all 505 stocks with the appropriate weightings to give yourself a mimic of the S&P 500 index. And instead, you can buy one share of SPY for $445, and therefore you will own a cross-section of the entire economy, because you will own basically 500 different companies that go across every single sector of the US economy. So ETFs are a way that you can get a very easily diversified portfolio for minimal entry costs, as compared to if you wanted to go out and create that portfolio of diversified investments yourself. Here's a quick challenge for you. Why are there 505 stocks in the S&P 500? Is this index inappropriately named? Should we call it the S&P 505, or is the S&P 500 the right name for it? So go ahead and try to find the answer online, and then leave the answer down in the comments below to let me know what you come up with. The S&P 500 ETF is a very basic ETF, as it simply tries to match the performance of a well-known stock index, which is the S&P 500. But if you go and explore the ETF world, you will quickly find that there are some very exotic ETFs out there. And one of those is the FOMO ETF, or the Fear of Missing Out ETF, which is a new one in 2021. And essentially the objective of this fund is to pick momentum stocks to provide aggressive investors or high-risk investors exposure to all these momentum stocks, which definitely includes those meme stocks you've been seeing around the internet. I definitely wouldn't recommend this one, as they only have 5.7 million in assets and are charging a close to 1% annual management fee. But I just want to throw it out there that all ETFs are not created equally, and there are definitely some very exotic ETFs out there in the ETF world. And that's why it's important to go to their website and actually do a little bit of research before you buy into shares of that ETF. Another exotic ETF example would be SQQQ, which is actually one of the most actively traded ETFs, if not the most actively traded ETF in recent history, according to ETFDB.com. Now, this is an excellent ETF to bring up, because in the world of ETFs, there are what we call leveraged ETFs. Now, these are not standard ETFs, because leveraged ETFs aim to return a multiple or an inverse of some index. So in the case of SQQQ, this is a triple short leveraged index ETF that tracks QQQ, which is the NASDAQ 100 ETF. The way SQQ works is, since it's a triple leveraged short or bear ETF, it means that if QQQ goes up by 1% in a day, SQQQ will go down 3% in a day. And on the contrary, if QQQ goes down 2% in a day, SQQQ will go up 6% in a day. So these leveraged ETFs are designed to return a multiple of some underlying index ETF on every single trading day. This is really important to mention because if you're new to the ETF world, you have to watch out for these leveraged ETFs, because leveraged ETFs are not designed for long-term holding periods. And on their websites, they actually say this product is not designed for buy and hold investors, and they're more so catered to short-term traders. You can identify leveraged ETFs because they will have something like bull, bear, 2x, or 3x in the name. So look for those power words or multipliers, so to speak, in the ETF name to quickly identify whether or not it is a leveraged ETF. If you accidentally buy and hold a leveraged ETF for a period of weeks or even months, you might get absolutely fleeced. So please do not make the mistake of accidentally investing in a leveraged ETF when you are simply thinking that you're investing in whatever underlying index that particular leveraged ETF tracks. I do have an entire video dedicated to leveraged ETFs, which you can access by clicking on this little button up here. If you click that card, you will find the link to the leveraged ETFs video, which I did quite some time ago. So if you're interested in learning more about leveraged ETFs, please go ahead and check out that video. So the first reason you should never buy a mutual fund is because you can accomplish pretty much the same exact thing of any mutual fund out there by looking for an ETF with a very similar, if not the same objective as that mutual fund. And that's just one reason. Before we put the nail in the mutual fund coffin, I want to discuss the magic mechanism that keeps ETF share prices in line with their net asset value. The net asset value, or NAV, is essentially the true share price that represents how much the value of the fund's assets are divided by the number of shares. And because ETF shares trade on public markets, the share price can sometimes detach from the NAV, or net asset value, meaning that the shares can trade at a discount or a premium to the net asset value. And that means that the ETF shares are mispriced relative to the actual value of the ETF's holdings. So what keeps the ETF shares in line with the actual net asset value, or true share price, based on that fund's holdings? The magic force that keeps things in line in the ETF world are called authorized participants, or APs for short. I'll just say APs since it's a little bit quicker than saying authorized participants every single time. APs are financial institutions that have relationships with the ETF issuer, and typically the ETF issuer will choose the APs when they launch their ETF. The job of an AP, or authorized participant, is to keep the ETF share price in line with the net asset value of that ETF. So basically, the AP is going to step in whenever there's an ETF share mispricing available in the market. The ETF share creation and redemption process is what allows APs to do this and keep ETF share prices in line with the NAV, or net asset value. Let's use the S&P 500 ETF SPY as an example to understand how this would work in the real world. So let's say SPY shares are trading at a premium to the net asset value, meaning that SPY shares are actually trading more expensive than they should be based on the net asset value, or the actual value of the fund's holdings divided by the number of shares outstanding. Since SPY shares are trading at a premium to where they should be, an AP will step in and basically buy up a portfolio of the S&P 500 stocks, and they will deliver it to the SPY ETF issuer. And in exchange, the SPY ETF issuer will give the AP blocks of SPY shares. And by doing so, the AP will effectively add buying pressure to all of the S&P 500 component stocks, and then they will receive the SPY shares from SPY, the issuer, and then they will sell those SPY shares on the open market, therefore adding selling pressure to SPY's ETF price. And by doing so, they will actually profit from that mispricing, and they will remove the inefficiency in the market by adding buying pressure to the S&P 500 component stocks and adding selling pressure to the overpriced SPY share price. In the reverse scenario, let's say SPY's shares are trading at a discount to NAV, and in this scenario, the AP will step in yet again to profit from this mispricing, except this time they will do the exact opposite that they did in the first scenario. So if SPY shares are trading at a discount to the net asset value, then the AP will buy shares of SPY and they will deliver the shares to the ETF issuer. In exchange, they will receive a basket of stocks, of S&P 500 stocks with all the appropriate weightings, and then that company or the AP will sell the basket of stocks that they received from the ETF issuer. And what this does is it adds buying pressure to SPY's share price. Since the SPY share price is actually trading at a discount to NAV, the AP is going to step in, buy the shares, and then they are going to receive the S&P 500 component stocks, which they will then sell on the open market. So by doing so, they add selling pressure to the S&P 500 component stocks, but they add buying pressure to SPY's share price, which removes that inefficiency that is trading at that moment. In each scenario, the buying and selling pressure from the authorized participant results in the removal of the mispricing of the ETF shares relative to what the shares should be trading for, which is the net asset value. The last thing I want to mention here is that it's good to keep in mind that when markets get highly volatile, the markets also get more illiquid, meaning it's harder to buy and sell securities when market volatility is really high. And in that event, you should not expect the asset price or the ETF share price to remain closely in line with the net asset value of that ETF, because when it's harder to buy and sell securities, that means it's going to be harder for the authorized participants to actually do their jobs efficiently and keep that ETF share price in line with the NAV. All right, now it's time to learn why you should never buy mutual funds again. And in this section, we are going to compare ETFs and mutual funds side by side on a number of different topics. The first difference is that mutual funds typically have minimums that you need to actually start investing in the mutual fund. So that could be $500, but in some cases it could be thousands of dollars that you are required to invest before you can even get started with investing in that mutual fund. With ETFs, there is no minimum with the exception of whatever cost it is to buy one share of stock. So in the case of something like SPY, you would need $445 or $450 to invest in one share of SPY. But for something that's a little bit cheaper, you could buy into an ETF that's $50 to $100, for example. So with ETFs, there are no minimums, but in the mutual fund world, there often are minimums, which could be thousands of dollars just to get started. The second thing that makes mutual funds worse than ETFs is that they are illiquid. The concept of liquidity means that you can buy and sell a security very quickly with minimal price loss. So for example, if I can buy a share of stock for $100 and then immediately turn around and sell it for $99.99, then that is an example of a liquid security. With mutual funds, they do not trade on public stock exchanges, and therefore you can't trade them like you would shares of an ETF, because ETFs do trade publicly on the markets, and therefore you can trade them all day long, assuming the stock market is open. With mutual funds, you can only trade them once per day, which makes them illiquid. Additionally, mutual funds can have a lock-in period, which is a period of time with which you cannot withdraw your money from that investment. The third thing that makes mutual funds typically worse than ETFs is their fees. There are a couple fees you got to watch out for when you're investing in mutual funds. The first is the expense ratio, which is basically the annual amount of your assets that that company is going to take for managing your money. So for example, if the expense ratio is 1%, that means you are going to pay a fee totaling 1% of your invested assets per year. So if you invested $10,000 into a mutual fund with a 1% expense ratio, you would pay $100 per $10,000 invested on an annual basis when investing in that mutual fund. Ideally, you want to see an expense ratio lower than 0.25% or 25 basis points, but of course, the lower the better. So an example of an extremely bad mutual fund is the Pacific Advisors Large Cap Value A with the symbol PAGTX. The expense ratio on this fund is 6%, and that means the fund takes 6% of your invested assets every single year. So if you had $10,000 invested, they would take $600 of your assets per $10,000 invested on an annual basis. The expense ratio of VOO, which is the Vanguard S&P 500 ETF, is 0.03%, and that means on a $10,000 investment, you would pay $3 on an annual basis in management fees for being invested in VOO. The second mutual fund fee to look out for is called the load fee. Now this comes in two forms, and that's the front load or the back end or deferred load. So a load fee is essentially the percentage of assets that you are going to be charged from that mutual fund issuer when you either enter or exit the fund. If you have a front end load, that means you are going to be charged a percentage of your assets just for getting involved or invested in the fund in the first place. Now, a deferred load or back end load is the percentage of assets that you will be charged when you exit the fund. So in this PAGTX mutual fund, we can see that it has a front end load of 5.75%. This means if I invest $10,000 into this mutual fund, right off the bat, they're going to take $575 from my assets and basically call it a sales fee. Now, if you have a back end load, whenever you go to exit the mutual fund, you will pay that percentage of your assets to the mutual fund issuing company just for exiting the mutual fund. The benefit of ETFs is that you do not have any front end or back end loads when investing in ETFs, which means you will never be charged a percentage of your assets for buying or selling shares of an ETF when you invest in it or liquidate that investment. So hopefully this helps you understand that there's virtually no reason to buy mutual funds because more often than not, you can find an ETF which has lower fees across the board and has a very similar, if not the exact same objective as a mutual fund does. So now that we've thrown mutual funds in the trash, let's go back to our ETF friends and talk a little bit more about some of the most popular ETFs that are out there so that you can get an idea of what ETFs you might want to consider for trading or investing in your own portfolio. Just like the world of stocks, there are good stocks and there are bad stocks. And when we get to the ETF world, as I mentioned earlier, there are exotic ETFs, which you probably want to avoid. And there are very popular ETFs that pretty much everyone knows about. And that's what I want to talk to you about right now. When we explore the ETF world, we can pretty much break it down by asset class. So when we go to the equity world, we have SPY, which we've talked about, and that's one of the S&P 500 ETFs that is incredibly popular and is the most popular ETF in terms of the assets that they have under management. And as we touched on earlier, SPY has about $390 billion in assets in the fund. We have QQQ, which is the NASDAQ 100 ETF, and this is an ETF that's going to be investing in technology companies. Moving on from there, we have something like IWM, which is going to be investing in the Russell 2000 stocks, and that means it's going to be investing in small cap stocks. Lastly, we have DIA, which is the Dow Jones ETF, and DIA, or the Dow Jones, is investing in 30 blue chip companies in the US. Moving into the bond world, we have an ETF AGG, which is the largest bond ETF by assets under management. But then we can go into more exotic things such as HYG. And HYG is the high yield bond ETF. And this means that the ETF is invested in high yield bonds, meaning that the bonds have a high yield, meaning that they are very risky. So this is a high risk bond ETF. Moving on to TLT, this is a much more popular ETF, at least in my world or from my experience, but TLT invests in 20 plus year duration US Treasuries, which basically means it's investing in US Treasury bonds with more than 20 years until maturity. So much safer than HYG in terms of the yields or the riskiness of the bonds that make up its portfolio. And in the commodity world, we have ETFs such as GLD, which is an ETF that holds gold. And then we have an ETF SLV, which is an ETF that holds silver. There are tons more ETFs in all of these different asset classes, so I'll leave a link down below to a website called etfdb.com, in which you can use a screener to sort for different asset classes and look at ETFs with lots of assets under management or ETFs with a lot of recent trading volume to find some of the popular names within the ETF world. Last thing I want to do, as promised earlier in this video, is to show you how easy it is to buy and sell a share of an ETF. So what I'm going to do is just open up my trading platform, which is tastyworks. I've been using tastyworks for years. If you want to learn more about them, you can look at the links down in the description below. But I want to focus right now on buying and selling shares of an ETF just to show you how easy it is to enter and exit a trade in an ETF when using any major brokerage platform. So it doesn't matter if you're using tastyworks, if you're using something like Robinhood or Thinkorswim, it's going to be pretty much the same process. So let's dive in. So I'm going to go to the trade tab of SPY. Actually, I don't need to do that, but all I need to do here is go to where the bid and the ask prices are listed. To start an order to buy a share of SPY, all I have to do is click on the ask, and then this starts to queue up an order to buy shares of SPY. In this case, the default order quantity is 100 shares, and I do not want to buy 100 shares because that would be close to $45,000 in an investment. So I'm just going to change the quantity to 1. Now currently we can see that SPY is trading with a bid price of $446.07 and an ask price of $446.07, but it's changing since the markets are open right now and the prices will change. So all I have to do here is enter my order, and my order price is automatically updating to the mid price of the bid and the ask. So basically the mid price is just the midpoint between the bid price and the ask price, and that's generally a good price to enter and exit trades at. So that's what I'm going to do here. So I'm just going to go ahead and click review and then send order to try and buy a share of SPY for $446.05. But currently we can see that the bid and ask price is a little bit higher than my initial entry price, and so that's why I'm not yet filled on my trade. But if we wait for a couple moments, well, there we go, it just went off. So what happened was I entered a order called a limit order, which basically means if I am buying, I don't want to buy the share unless I can get filled at my price or better, which means lower in the case of buying the share. And so since I entered that order and then SPY shares started trying to trade a little bit higher, I was actually not able to get filled on that trade. But then once the share price came back down to my order price of $446.05, I was filled on that trade. So now if I go to my positions and I click on SPY, we can see that I have one share for a trade price of $446.05. And since the shares are trading for $446.07, I currently have a 2-cent profit on this position. Let's go. So now I'm actually going to sell this just to exit it and just to show you how easy it is to enter and exit a position. And this is something that I would kind of recommend if you are a beginner, just to understand how easy it is to enter and exit trades when you're trading things that are very liquid, such as SPY. So all I have to do here is click on this share, right click it, hit close position, and then this is going to start an order to sell this share of SPY. Now currently the mid price is $446.03. I'm just going to change this to $446.04, or actually $446.05, and let's see if I can sell this at no loss. So there we go. So I've successfully purchased one share of SPY, therefore entering the position, and then I closed that position moments later, as you saw, with minimal effort by selling that share that I purchased. And if we go to my activity tab, we can see that I bought one share of SPY for $446.05, and then I later sold that share for the same exact price, therefore realizing no profit or loss on that transaction. Earlier in this video, I mentioned that I had another video on leveraged ETFs, and now that you are a pro in the world of ETFs and how they work, I would definitely recommend watching my video on leveraged ETFs, which you can do by clicking on the card right here, as you are nicely set up to learn about the more advanced world of ETFs by watching my video on leveraged ETFs to learn more about how those work and why you should or should not invest in those. So be sure to check out that video right now.